Welcome to the Friday edition of Tech Stocks Daily. Today we're diving into some high-stakes Nasdaq action that'll have you on the edge of your seat. First, we'll break down DocuSign's earnings surprise and why their shares took a nosedive. Wonder what's bubbling inside Braze? We'll explore their revenue boost with a side of investor skepticism after that strategic acquisition shuffle. And let's not forget ABM Industries, strutting its stuff with unexpected revenue triumphs amid some cautious moves. So, flaunt your headphones and get comfy as we unravel today's tech stock dramas, offering insights you won't want to miss. Hey tech lovers, buckle up because today's spotlight is on a paperless pioneer, DocuSign, which has been having quite a roller coaster ride in the stock market today. Anyone wants to decipher those electronic squiggles? No? Just me? Alright, we're sticking to DocuSign. So DocuSign has been making headlines today, but not for the reason you might expect. They recently posted their first quarter financial results, and while the initial numbers might make you throw confetti, at least until they hit the floor, that celebration was short-lived. The DocuSign earnings report revealed some exciting stats. Better than expected earnings per share of 90, sprinting ahead of the 81 predictions. Revenues also climbed up to $763.7 million, beating the street's expectation of approximately $748.13 million. Subscribers and service split, not forgotten. Subscription revenue reached $746.2 million, showing an 8% increase, while the less glamorous cousin, professional services, ticked up 4% to $17.5 million. But wait, here's the plot twist that transformed ticker symbols into alarm bells. Despite breaking and exceeding the earnings guesstimate, shares plummeted by around 19% today. It's like winning a baking contest, but dropping the cake before the judges get a bite. Investors were disconcerted by less than explosive billings growth, just a 4% climb. And more importantly, the free cash flow decided to go on a mini diet, shrinking slightly to $227.8 million from last year's $232.1 million. So who turned out the optimism lights? Warnings of decelerating revenue and billing growth painted a somber picture with muted fiscal guidance. DocuSign predicts revenue for fiscal 2026 to be around $3.15 billion to $3.16 billion. While it's an increase, it ain't the high-speed train investors were hoping to catch. Slow growth and murmurs of an anticipated momentum fade added raindrops to investors' hopeful parades. Adding a spark, or perhaps a question mark, DocuSign announced a $1 billion share repurchase plan. Yay for buybacks, but the excitement deflated somewhat, considering it's bound to just counteract increased share-based compensation. In short, Wall Street snubbed the results and focused keener eyes on future growth challenges. Competition looms large from Adobe and Microsoft as DocuSign wrestles to not just shore up its e-sign fortress, but also expand it into new territories. Their strategic direction under CEO Alan Thygesen aims at shaking things up, but investors eye the speed at which DocuSign's roadmap promises growth with skepticism. Shares took a dive, trading at about 18% lower than expected, around $75.81, after the analysts trimmed their forecasts. With DocuSign aiming to push boundaries on digital agreements, the question on everyone's lips is how quickly growth will follow to truly reflect its pioneering reputation. So DocuSign fans and investors seem to be biting their nails, waiting to see if the company can successfully shift gears from immediate satisfaction to long-term growth. Remember folks, in tech, just like in career moves, past performance doesn't always guarantee future success. DocuSign still stands strong as a market leader. It just has a bit of a rocky road to pave before the stock might pop that champagne again. Stay tuned. All right, everyone, buckle up because today we're diving into the world of Braze, the customer engagement platform that's been making quite some waves on the Nasdaq lately. So what's all the fuss about? Well, Braze has been in the limelight due to its latest quarterly earnings report, which brought both good news and some results that had investors scratching their heads. First off, Braze did manage to beat market expectations, posting quarterly earnings of 7 cents per share compared to an anticipated 5 cents. Their revenue followed suit, clocking in at $162.06 million versus the expected $158.66 million. So far so good, right? But hold on, the plot thickens. Despite a solid performance in this quarter, Braze ruffled a few feathers by tweaking its full-year guidance for earnings per share. Initially, the company had set a more optimistic EPS range for FY 2026, but they're now singing a different tune, forecasting earnings as low as 17 cents per share. This comes alongside a revenue guidance upgrade for FY 2026 to the $702 to $706 million range. While increasing revenue is generally a cause for celebration, the sharp drop in projected EPS had some investors stepping back with a raised eyebrow. What's driving these mixed signals? A strategic acquisition spree could very well be the culprit. Braze recently incorporated OfferFit, which, while a long-term strategic win, hasn't yet settled into the company's operational framework. Layering in OfferFit's costs dampened the operating margins slightly, and while this acquisition bodes well for future product innovations, birdwatchers in the investment world started to grow cautious. Now, let's sprinkle in some industry insights. Despite EPS concerns, the company seems to be muscling its way through these growing pains with resilience, citing broad strength in several industries and a confident smearing picture in trade conditions globally. Bill Magnuson, co-founder and CEO, didn't seem downbeat. Instead, he shared optimism because Ed McDonnell, a new head honcho of global revenue operations, joins Braze, bringing a glittery resume of achievements from the SaaS world. But not all numbers were sunny. The dreaded word in investor meetings, retention, popped up. Braze's dollar-based net retention took a tumble, recorded at 109% this quarter from 117% last year, meaning their existing customers are still spending, but not as rapidly as before. Yet, with 10% more customers and a 24% rise in high-value annual contract figures, there's a canvas of positivity for the future. In summary, today's headlines tell a tale of dual narratives. Braze shows up stronger today, promising a bright revenue boost for tomorrow, but with profitability guidance that's taken an unexpected turn. Investors have some food for thought, with eyes peeled for next quarter results as they decide whether Braze's vision holds the gravity necessary in the tech constellation. All right, tech enthusiasts, let's dive into today's spotlight on ABM Industries and uncover why they popped up on our news radar. It turns out that ABM Industries had quite a teaser-filled day, revealing their second quarter earnings and giving us a mixed bag of results that have investors scratching their heads or polishing their investors' caps a bit. Let's inspect this juicy tidbit. ABM Industries, known for their vast service portfolio ranging from cleaning services in fancy offices to facilitating your smooth travel through airports, announced second quarter revenue of $2.11 billion. This was an eyebrow-raising figure, nudging ahead of the consensus estimate of $2.06 billion. Their growth was fueled by impressive performance margins, particularly in their technical solutions and aviation divisions, which saw a year-over-year boost of 19.3% and 9.2% respectively. Who knew cleaning and airport facilitation could soar so high? High five to you, ABM. The earnings report also brought a minor downer. ABM reported earnings per share of 86 cents, just a tick behind the analyst's expectation of 87 cents. The slightly conservative full-year guidance range of $3.65 to $3.80 per share has made some investors skittish, especially with broader market uncertainties looming like a storm cloud in their backyard. Investors beware, the consensus was $3.77, but don't drown in worry just yet. ABM CEO Scott Salmirs sounded quite optimistic about recovery, citing expectations for delayed projects to find their feet in the third quarter. Peering further into the financial belly of the beast, ABM managed an operating profit rise of 1.2% year over year, with adjusted EBITDA increasing to $125.9 million. But hold on to your calculation hats, because in riveting financial cruncher fashion, they've also rejigged their non-GAAP measures after a chinwag session with the SEC, incorporating prior year self-insurance adjustments. Get your spreadsheets ready. Despite some hesitations among market watchdogs, ABM's price action saw shares ticking up 0.06% pre-market. Now that doesn't sound like Christmas bells, but it's a snug nudge northward. Dividends remain delightful, with a consistent cash reward of 265 cents per share set to drop into shareholders' laps by August 4th. So, reward defenders can snooze a little easier, likely counting those extra pennies as they review their transactions. Here's where you come in. What do you think about ABM Industries' performance and future guidance? Are you bullish, bearish, or simply agnostic as you clean under the sofa cushions looking for investment opportunities? Dive into the comments section and let us know your thoughts on ABM navigating the crests and troughs of its industrial future. Do you reckon the cleanup crew is on the right track? Or should they grab a mop and bucket for hush-hush adjustments? Let those keys clack and chat away. All right, tech traders and savvy investors, let's hone in on DocuSign. After today's roller coaster ride, I've strapped into the recommendation seat for a cautious hold, but let me break it down sip by sip like your favorite artisanal cold brew coffee. First off, the good stuff. DocuSign breezed past expectations with better than expected earnings per share and awarded themselves a couple of medals with rising revenues. But remember, this is as much a race of perception as it is of performance. And the finishing line looked a little wobbly with some potential future hurdles. Despite that confetti-worthy earnings report, the air quickly left the celebration balloon when billings growth read more like a snail race. The free cash flow shrinking didn't do much to bolster confidence either, making some investors clench tighter to their piggy banks. The strategic $1 billion share repurchase plan is like pulling down the safety bar on this theme park ride. It offers some comfort. However, with plans primarily to counterweigh share-based compensations, it didn't raise eyebrows as much as hoped. Contentions rose further when forward guidance underwhelmed, much like a gentle canal cruise when you'd expected a motorboat rip through. Now, with competitors like Adobe and Microsoft lurking in the wings and growth projections simmering rather than boiling, DocuSign seems to require a significant proof of performance exam going forward. Their good holds still represent strong market standing and leadership within the digital agreement realm, but the gears in their growth machine might need some more tinkering. So, with the potential uncertainties and the road to aggressive recovery still being paved, a prudent investor could consider holding DocuSign stock to see how upcoming quarters shape up as per guidance. That said, remember folks, investing is as unique as your playlist. You might feel like dancing while others contemplate soft jazz. Always dive into the due diligence and swim through further research to make informed decisions that sync with your investment strategy. Keep those binoculars focused for clearer skies ahead and stay savvy. Today's tech market scene unfolds a classic tale of ups and downs. DocuSign, despite pulling off impressive earnings, felt the sting of investor caution due to lukewarm growth projections, turning excitement into apprehension. Braze exhibited a shiny revenue boost, but sent mixed signals with revised earnings guidance after a strategic acquisition move. Meanwhile, ABM Industries kept it steady with diversified growth, hinting at brighter days, but gently treaded cautious investor waters. All right, tech enthusiasts, if you enjoyed today's rundown and want to catch what's next on the Nasdaq Tech Radar, make sure to hit that like button and subscribe. Share this video with your fellow tech fans who love a good stock saga. Swing by on Monday for fresh updates and tech news bites. Have a fantastic weekend and keep those investment portfolios as vibrant as the autumn leaves. Stay tech-tastic.